Good morning, everybody, and welcome to this webinar, Profiting Through Innovation with Patent Box. 700 companies benefited from over £350 million worth of tax relief in the first year of operation of Patent Box, and individually these companies benefited from anywhere from £67,000 worth of benefits to £1.45 million of benefits. But of course, there's a cost attached to patents and a cost to registering within this program, and also the regime has actually changed into what may be described as a less favourable regime going forward. So what we have today are two experts in the area. We have Andrew Mackenzie from Scotland York IP Law, and we have Sarah Lochart-White from WFT Chartered Accountants. And they are going to be answering your questions, which I'm sure you have, which is it still relevant, and can companies still benefit from it? And the real questions are, who can benefit from Patent Box? What criteria do you have to meet? Who may be able to backdate filings under the old system? And what income qualifies? And how much it's likely to cost you to get these benefits? So without further ado, and to answer the very basic question, what is Patent Box? So Andrew, what is Patent Box?
Thank you, David. Sounds like a simple question, but there's quite a lot of detail here, but hopefully we'll cut through and get to the salient points for you. So Patent Box is a relief on corporation tax, and effectively the eligible profits are taxed at 10%. It is available for owners of a set of patents, which I'll go into later in the webinar. Broadly speaking, European patents and UK patents, and also exclusive licensees under those patents. And again, I'll go into exactly what exclusive is, because from a lawyer's perspective, the HMRC definition of exclusive is a little bit unusual. The scheme started in 2013, and as David said, we just had some reported figures last month from HMRC showing usage, which looks rather good, and we'll go into that in a bit more detail as well. The relief is tapered, and the full 10% rate is available for the tax year 2017-2018, so we're just getting to that. There's been a lot of debate about whether the scheme would continue, whether it would be something that would get shut down over time, and in fact, it seems the reverse is true. On the slide, you can see that the original scheme was based on several European countries, and in fact, Italy had just started a scheme, Canada had just started a scheme, the US had just starting a scheme, and perhaps the reason we should have more confidence that it will continue is that the OECD has now looked at this and produced some changes, which is why we have this new regime, but that mean that on a world basis we can be confident that Patent Box schemes are no longer likely to be considered harmful tax schemes. And the general thrust of the scheme is to try and get good value employment in the UK, so high quality R&D jobs in the UK.
To be able to benefit under the Patent Box regime, companies must elect into the regime within 2 years of the end of their accounting period in which the IP income arises. The election must be in writing, and it continues until it's revoked, and again, that needs to be in writing. So for example, if you've elected into the Patent Box regime and your patent expires, you still are within the regime, but you're receiving no benefits under that regime. Once the regime has been revoked, a company cannot re-elect into it for a further 5 years. So it's really important to consider the timing of when you enter into the Patent Box. For example, if to start with you think you're going to have losses arising from your Patent Box items, then it's generally not advisable to enter into the Patent Box regime, because those losses can only be set off against Patent Box profits. So generally you need to sort of work with accountants to actually factor in when is a good time to enter into a Patent Box regime. Also, as Andrew will probably go into detail in a little bit, a product only needs to have one patented item within it to allow all of that income on the worldwide sales from that product to be eligible for the patent box. However, the patented component must be integral to the product, but it doesn't matter about the size of it compared to the overall size of the actual product. The patent box legislation also allows for a 6-year look back where a patent application is pending approval. So this ensures that the company retains the benefit of the relief. So when the actual patent is granted, there'll be an adjustment within that year's corporation tax computation to bring in a patent box claim on those relevant profits going back in the previous 6 years.
So just looking at what happened in that first year in a little more detail. So you can see quite a large number of companies and quite a lot of relief. So the compliance costs, basically looking at some of your expenditure on R&D, looking at what profits can be attributed to things covered by the relevant patents, which we'll come into on more detail on all of those points in a moment. Not surprisingly, the largest sector that took advantage of this in that first year was the manufacturing sector, and 64% of the claims were from that sector. The second largest, which I was certainly a bit surprised by, at 16%, was wholesale, retail and transport. And they are not, from a patent attorney's perspective, classical users of the patent system. Often they're doing things that don't really fit into the constraints of what is patentable. And I think what we'll find there is that those companies have used the system quite cleverly and legitimately, looking at exclusive licenses and also some of the process patents and services that can be put in under this scheme with the appropriate patent claims. So who are you going to need to help you apply and continue to apply? Well, it's an unusual combination of professionals, certainly one I've not come across before, that patent attorneys and accountants need to talk to each other, which of course we do when we have to, but so you definitely need some accounting support. You need a good tax specialist who knows their way around this stuff. But clearly you need some patents, and really the only place those are going to come from is finding yourself a good patent attorney. Even the UK Patent Office, just this week I was at a seminar, and even the UK Patent Office was saying, please don't draft them yourself, please do go and see a patent attorney, which I thought was a very nice plug from a government agency. But they are complex legal documents, so you will need some sort of input from a patent attorney to get the right patent claims to make sure you can take full advantage of this scheme. And internally, you are going to need to bring together people that will understand what bits of your technology are covered by the patents, which will probably involve some of the technical function in the organisation, where that's being sold, how it's being sold, how much profit is being made, which is going to bring together sales and financial teams. So perhaps a slightly unusual team to bring together, but nevertheless, if you can do it, you can see that the benefits can be quite substantial. So we've skirted around one of the big issues. It's called patent box, so you're going to need some patents. You can only apply for the relief once you have granted patents, but as Sarah mentioned earlier, there are some backdating provisions so that if you get a granted patent, you can actually look back several tax years before the date of grant. The eligible patents are, as you would expect, those granted by the UK Patent Office, also the European Patent Office, and some of the EEA countries, but not all of them. And if I just quickly rattle off the countries, it's Austria, Belgium, Czech Republic, Denmark, Spain, Finland, Germany, Hungary, Poland, Portugal, Romania, Slovakia, and Sweden. From a patent attorney's perspective, I can see that those are the countries that actually conduct high-quality examination of their patents before they're granted. One notable exception there that you may have spotted is France, which doesn't conduct examination, and as long as you pay the appropriate official fees and fill the forms in correctly, you will be granted a patent in France. And I think HMRC quite rightly has seen that that might leave this scheme open to abuse if there was no test of the validity of your patents, if you could just go and get any old patent and then start claiming tax relief on it. At the bottom, you'll also see that it's not purely patents. There are other intellectual property rights, plant variety rights, so if you're a plant breeder, that could be quite interesting. Also data exclusivity rights, and supplementary protection certificates, which are extensions of conventional patents in certain fields, typically pharmaceutical fields, when approval of drugs has taken a long time, and it's felt right to grant you an extension to patent rights to balance that out. So what does patented mean in terms of the tax legislation? Well, normal patents, indeed the types that fall under this arrangement, have a set of legal paragraphs with numbers on called claims, and they define the scope of the patent. So if you're looking at a tangible item, a mechanical part, or a semiconductor chip or something, typically for that thing to fall in the patent claim, it would have to have everything listed in that claim. So every technical element that's stated in the claim in words would need to appear in the product. So that's fairly conventional patent infringement. So effectively what HMRC is looking for is, does your product fall within your claim? Would it infringe the rights of the patent if a third party were copying you? And similarly, patents can cover processes as well. If you've got perhaps a chemical process or a complex manufacturing process with all sorts of annealing and heating and pressing steps and so on, and that's new and inventive, then you could get a patent for that. And I'll come on to how the patent box deals with that, because having process claims raises some interesting issues when you come to look at what happens for tax relief on the product that you produce with that process. Now, patent box has changed the game for preparing patent claims. Usually you want the broadest claim possible because you're using a patent as a monopoly legal right. You're trying to keep people off your turf, as it were. You might be wanting a nice broad thing that you can license to others, or you might be wanting to keep the market clearer so that potentially you can increase your profit margin. Patent box changes that game because, as Sarah briefly mentioned, and I will discuss in more detail, you can get relief for the whole of an item if it incorporates a patented part. So it's now possible just to have really quite a narrow patent claim on quite a small component part of a product and yet still get full tax benefit for the whole product. So we no longer need to, for patent box purposes at least, have extended negotiations with the Patent Office to get nice broad claims. The Patent Office is always happy to grant very narrow claims because they don't really affect the public interest in the normal use of patents very much. Broad claims, of course, have the risk that the Patent Office grants something that is quite damaging to the public interest. So they don't really like granting patents with broad scope. And of course that means that for patent box, if there's not an extended negotiation with the Patent Office, we can actually do a fairly streamlined and relatively cheap patent filing for you for patent box purposes. So patent box actually completely turns on its head conventional patent claim drafting, which is something that a lot of users of the patent system haven't fully appreciated yet. I mentioned at the beginning that the real idea behind this is to create good quality R&D in the UK, and indeed that was the conclusion of the OECD as well when it reviewed these things. So if you want to get this sort of relief, there has to be either ownership of the right by the company claiming the relief, or active management of that right. And this begins to get to the point where the rules have changed. I won't go into that in detail. Sarah's going to cover that in a moment. But it needs to be clear that the newer rules require a much stricter connection between the company claiming the tax relief and who carried out the R&D that supported the patent right. Really, part of the reason for the timing of this webinar is that there are quite strong advantages to trying to get in under the old regime, and we're going to cover ways that you are still allowed to put things in under the old regime. Certainly it's something that you need some legal advice on, and you will need some accounting advice to make sure that you have the rights in the right bit of the company, and also that there is, certainly under the old scheme, some direct management of those rights by the company claiming the tax relief, and under the new scheme, even more onerous conditions. Fairly straightforward slide. This, you will need to show who owns the patent and whether you have licenses as part of the application. That's fairly straightforward to do. Really just mentioning that patents have a very strong relationship historically to real estate. So there is a register, just like there is a land registry, where owners of the intellectual property rights are recorded, and any assignments or licenses and so on. So that's fairly straightforward. That's all on a public record that you can get copies of. So exclusive licenses. This is a way, effectively, of taking the patent box benefit from the owner of the right through to a different entity. Now, exclusive licenses always exclude the owner of the right, and that's still the case under the HMRC definition. So a sole license is different. That is one licensee plus the owner of the right, but the exclusive license also excludes the owner of the right from practicing the invention. But as with all licenses, it's unusual to grant a license for all the rights available under the patent. So you would typically divide up the license territorially, or possibly into different areas of technology or operation. A classic thing, for example, in the automotive field is that you might license someone making vehicles over 3.5 tons and someone else licensing vehicles under 3.5 tons. So you might get the passenger vehicle and the heavy goods vehicle licenses in different places. And that's perfectly acceptable to HMRC, but the exclusivity and the divisions you make under those licenses, it must commercially exclude competitors, and that's a much narrower definition than a conventional exclusive license. So HMRC will look at whether you've got some rather strange terms in your exclusive license, which are not really dividing the market up in a truly commercial way and appear to be designed just to gain an advantage in patent box. The other thing that you'll see at the bottom of the slide is that the licensee must either be able to bring infringement proceedings on its own behalf, or be entitled to the damages. So obviously that second point is if the patentee brings infringement proceedings. That's not particularly exciting in that the patent statute automatically gives those rights anyway to an exclusive licensee, but they would typically be written into the agreement anyway, just so that everyone's clear how it's going to work and what the mechanisms are. But that actually restates the statutory position that exists anyway for a normal exclusive license. But normally you could do those things differently under a license. You could write it differently and change the way the statutory baseline operates. If you were to do that for patent box purposes, you would fall outside HMRC's definition of exclusive licenses. So you do need to make sure that one of those two bullet points at the bottom is met. And of course, those of you who've been involved with exclusive licenses will understand that it's actually almost essential to have those rights, because if the patentee has no interest in operating the invention because they're excluded by the license, then somebody needs to be free to enforce the rights, and typically that would be the licensee who would bring in the patent owner but pay the costs of litigation and so on. So that's all fairly standard stuff.
As well as the ownership conditions, there's also the development conditions, as Andrew has referred to earlier. So this is where the IP company must have shown that they have made a significant contribution to the creation or the development of the patented invention, or to an item or process which is incorporated in the invention. Under the old regime, there's also the opportunity of where the R&D has been carried out elsewhere in the group, so for example by a subsidiary company, that the IP company must have shown that they've taken a significant role in the management of the portfolio of that relevant IP. This is known as the active ownership condition. So for example, they need to have been involved in sort of formulating plans, making decisions in relation to the development or the exploitation of the rights. So, for example, decisions to maintain protection in the country, to pay the annual renewal fees, grant licenses, research alternative applications for the innovation, or licensing others to do so. The new regime has come about as a result of the OACD's recommendations under Action 5 of its action plan on the base erosion and profit shifting basis. And this is where they were looking at countering harmful tax practices. I mean, patent box itself is not necessarily harmful, but it does take account of the preferential tax rates. The OECD basically recommended that all preferential IP regimes had to be amended by the 1st of July 2016, and the new regime must comply with a nexus approach. But generally, this is less favourable. It does mean that profits arising from qualifying IP are only available at a preferential tax rate where the company incurs the R&D expenditure themselves that has led to the creation of IP. However, they will also be able to subcontract R&D to third parties. The rules do apply to the entity undertaking the work and not to the territory in which the work is undertaken. So there is an opportunity for overseas branches of the UK entity to possibly qualify under the patent box regime. Now, another point of the new regime is that we will need to split patent box profits on a patent-by-patent basis. This will put an increased compliance burden on the entities in question, as they'll need to be able to trace all of the R&D spend and be able to track it against individual IP assets. They'll also need to stream the qualifying profits on a patent-by-patent basis, which is obviously going to involve a lot more work and effort in bringing those figures out.
So the changes to the rules were brought in by the Finance Act 2016, which amended the Corporation Tax Act of 2010. Now, the cut-off date is quite interesting. That's brought in by new section 357 BP. See, they're beginning to run out of letters because there's an awful lot of extra sections going there. The draft legislation was unclear. If you know about patents and priority dates, you'll know that some national law switches in priority date for patent date. And if you don't know about patents, that's going to sound immensely confusing. The bottom line is that there isn't a simple filing date. There were some representations made during the consultation phase about this section of the Act. Unfortunately, no changes were made to the draft. So we now have a situation where potentially we're not quite sure what you need to do to meet the 1st of July 2016 deadline. What is clear is that if you have a straightforward patent filing date, so you've actually put the patent application into the Patent Office before 1st of July 2016, then you can get the patent into the old regime. If, however, you have a filing that is not in one of those countries that I mentioned earlier in the webinar, and under the normal patent system, you might use the Paris Convention priority date to backdate, for example, a European Patent Office filing. It probably doesn't allow you to move into the old regime, but it might. So if you've got something very valuable, that's certainly one place to look to see whether you can still put your patents under the old regime. The other very clear way of doing that is if you have a filing under the Patent Cooperation Treaty with a filing date before the 1st of July 2016, when you're looking at which national and regional phases to extend that into, you would want to look at that list of patent box countries, because if you start a national or regional phase in the right countries, you will definitely be eligible under the old regime as long as your original Patent Cooperation filing date was before 1st of July 2016. So there's still, and that will continue for about another year from where we are now, so there's still quite a long time when taking the right steps will still allow you to get the patent dates, at least, into the right place to be eligible under the old, more generous regime.
As I mentioned earlier, we need to be able to split the patent box profits on a patent-by-patent basis. Then, under these new rules, we need to further restrict the amount of profit which is eligible to be taxed under the patent box rules by what is known as the nexus fraction. This fraction is based on the amount of R&D incurred to date rather than the annual spend, and it goes back as far as 1st of July 2013, which is when the patent box regime came into force. The R&D fraction is computed and it's applied separately for each relevant IP stream. Now, I've put the fraction up there on the slide, and you can basically see that you'll now need to actually look at your R&D spend and analyse it between A, which is expenditure of the entity, B, subcontractor third-party expenditure, C, the connected party R&D expenditure, and D being the acquisition expenditures on IP. Basically, the fraction, the nexus fraction, is the lesser of 1 and that fraction. And as you can see, there's an uplift that's been given of 30% to allow for some relief for the outsourced R&D and acquisition costs. We'll look at a bit more detail of that fraction towards the end when we have a case study where we look more closely at the actual calculation of the patent box deduction. There is an increased burden put on companies in order, under this new regime, to be able to trace their R&D. So they need to be able to track all R&D expenditure against the IP assets to which it relates. There's therefore question over whether the R&D you incur is generic or product related. And as can be seen from the new regime, we do need to be able to track R&D against products rather than just having it as generic. So it will be important to actually try and identify which products the R&D actually relates to. There might be one product, or you might have several products, and again, you'll need to keep financial information in relation to each product. We also need to keep a lot of historical data, because in order to calculate the nexus fraction, we'll need to go back to 1st of July 2013 to be able to build up a picture of the R&D spend on each particular product. So therefore, in 2016, companies can be under the old regime and they can come within the new patent box regime. The old regime will be enforced until June 2021. The development conditions under the new rules are a lot tighter than they were under the old rules. So an entity will still have to show a significant contribution to the creation or development of the patent invention or an item or process incorporating the invention. But as we saw earlier, the R&D has to be incurred by the entity or the subcontractor to third parties rather than being carried out elsewhere in the group. If the R&D is carried out by a trading subsidiary within a group, then as you can see by the previous slide, there will be a reduction in the patent box benefits because of the application of the nexus fraction.
Am I right in thinking, Sarah, that the R&D, if you do an arm's length thing, that doesn't have to be a UK organisation.
No,
Yeah.
that's correct. I think, as I said earlier, when you're looking at the particular entity, it doesn't actually matter. So we can bring in, we have an overseas branch of the UK entity, then that's potentially within the patent box.
So it's actually better to do the development outside your company, maybe, or at least the patent box advantage. Seems a bit strange.
Yeah.
Okay. Well. So, now we get to some of the juicier stuff about what you could actually be doing in terms of your products. You mentioned earlier that you are allowed to get full relief for a product if it incorporates a patented product. So going back to my comment about how patent claims work, so if you had, for example, a printer cartridge, you had a patent claim which was directed just to the cartridge, but you actually incorporate it into a printer, you would be able to claim your tax relief on the profits from the whole printer, which is rather nice. Something I haven't put on this slide because I don't think it's terribly useful is it actually works the other way around. If you had a patent on the printer, you could, which then incorporated the printer cartridge, and you're selling the cartridge separately, you can claim some patent box relief on the cartridge. The reason I think that's not very useful is that it's very rare to have such a large claim on something like a printer, because patent claims can only be granted to something new and inventive, and unless you're in a very disruptive area of technology where you come up with something completely new, it's very unlikely you're going to have a patent that covers such a large bit, a large product. So it's much more likely that you're going to have patents covering little parts of things, and the system is very generous to that. Having said that, there are plenty of anti-avoidance rules around that. The example that the HMRC commentary gives is of a loudspeaker manufacturer who puts a sound processing chip inside the case of the loudspeaker, but doesn't actually wire it up to anything. So it has no function at all in the final product, but happens to have a patent on it. Well, HMRC are going to see through that and treat that as tax avoidance. So you can't play games with this, but at least you can't legitimately play games with this. But if you really do have a fairly narrow patent on something, and this comes back to what I said earlier, that you don't need broad patent claims to take advantage of this. If you have a very narrow patent on a little fastening mechanism or something like that, and that happens to be incorporated properly into a much larger product, automotive manufacturers' ears are pricking up at this, I might add, then you can get an enormous amount of relief through this system. Now, I mentioned process claims earlier, and this gets a little more complicated. So if you have a type of claim which you're allowed to have, where you say something like a fastener created by the process of a previous claim, you're allowed to have that under patent law, and that's actually quite a nice claim to have under patent box. The catch is that all of the countries that are eligible for patent box will require that screw itself to be novel and inventive. It's not enough that the process it's made by is patentable. The screw produced by that, or whatever it is, by that process also has to be independently patentable. Otherwise, you're not allowed to be given a patent claim. So ideally, if you're drafting a patent for patent box, you want to put explicit product by process claims into the patent, but they are quite hard to get. Again, unless you're in a disruptive area of technology, if you've simply got a clever way of making something that is already available, you might get a patent for the process, but you won't get a patent for the product itself. There is a small exception to that, or a sort of saving, really. Under patent law, any product directly obtained from a patented process is potentially infringed by a patent. So coming back to my very simplistic screw example, if a competitor were to produce a screw using your clever process and you could prove it, which in itself might be quite hard, but let's say you can prove that, then under patent law you would be entitled to damages from that competitor and other relief like injunctive relief and so on, the normal relief for that screw. Now similarly, HMRC have allowed a small saving there in that they say, well, you can make an allowance at a notional royalty rate. So the sort of royalty you would have to pay to buy that product in could be allowed in your patent box application. So not all is lost if you can't get an explicit product of process type claim, which I have to say are quite hard to get. I'll repeat that again because they really are. If you just have a process claim, you can put some relief in, but it'll only be at a notional royalty rate, which typically is not going to be a particularly high percentage. But it does open up the idea that you can have some quite interesting things in the patent box service, in the patent box application, like services. I've put an idea at the bottom there. If perhaps you've got a clever piece of software, for example, which produces some special effect, let's say for architects, then potentially you might be able to get some of the services they're delivering allowed under the patent box scheme, but probably only at a notional royalty rate. Just some thoughts there, and I suspect that's where some of those wholesale and retail applications have come in that were in that slide looking at usage in the first year of availability of the scheme. And just quickly, it's not only income from products itself that are allowed under here. If you are licensing your IP out in the right way, so this is the effectively the reverse of the thoughts you were having about exclusive licenses. If you've got the right type of license, then you can put your income and royalties into the patent box. And also, if you are litigating your patents and you receive some cash, so under UK law at least, that's either in the form of damages or an account of profits, then those amounts can also be put into the patent box and receive tax relief. And also on disposal of IP rights, again, benefit received in the company for the disposal of those qualifying IP rights can be put into the patent box and receive relief. So if you have an existing portfolio, then moving some things around may be worth doing. It's worth noting that there were some cut-off dates for that in January 2016, broadly speaking, to take advantage of the old regime. So it's not possible to move rights around now to avoid the nexus rules. You will end up under the new regime for that. But there are perhaps opportunities to look at exclusive licensing, still going to be under the new regime, and just look at whether perhaps you're missing opportunities to patent products, because it's now no longer the case that you need these broad patents, at least not for patent box purposes. So it may be that things that in your internal review processes you've rejected from patenting because you didn't think it was worth having conventional monopoly rights might well give you a benefit in a different way by allowing you to put new product lines into patent box and receive the financial benefit in the form of corporation tax relief rather than increased profit margins or licensing income and so on. So the system does really need a different way of looking at what should and shouldn't be patented, which entities will own those rights from the conventional arrangements. And just finally, at the bottom of the slide, do have a look at whether you've got some pending international or patent cooperation treaty filings. I'm thinking particularly of any listeners outside Europe here, where you may still have opportunities to get the right patents in the right territories to take advantage of these patent box arrangements. So just very quickly, what should you be doing in terms of patents? Well, look at what you've got already. Patent box has been around for a few years, but there are still companies that I know and clients of ours who haven't really found the time to review this properly. So review your existing rights and definitely change your internal review processes for deciding what should be put forward for patenting, because this system does change the criteria that you might apply to those decisions. All you need is a single UK patent filing. If all you're interested in patent box, the official fees are a few £100s. We routinely get them granted in under a year if we can show a good reason. The patent office is creaking under the load of your competitors doing that, I might add. The patent box is cited as our main reason by the UK Patent Office for them slowing down on examination of the work that we're putting through there. I think look at your portfolio and look at what of your existing product lines are covered by your existing portfolio. And you might already have recognised this, but a lot of users of the system are actually indulging in a twin-track approach, where they're going for very quick, narrow patents, which go through quickly because they're accelerated, and also because, as I said earlier, you don't have to spend a long time negotiating with the Patent Office on narrow patents. They're not that worried about allowing them, so it's quite an easy process, and often these things are going through immediately without any objections at all, which is how we're achieving sub 1 year grant, which in patent terms is very, very quick. A more typical time scale would be 5, 6 or 7 years. And it is possible to split that strategy and still carry on with parallel applications with broader protection, which will be slower probably to grant, but so that you can have your more conventional benefit from patents in terms of keeping a clear area in the market or licensing income. Just very quickly, if you have a portfolio that you're using to underpin a patent box application, please do make sure the patents haven't expired and that you pay the annual renewal fees that are due. If you fail to do these things, you no longer have a patent, and if you do that for too long, there's no way to get that patent back. That could be a very easy way of losing a lot of benefit. Cost of renewal fees are a few £100s in the UK Patent Office, but of course you need some good systems, or you need to ask someone else to monitor those dates very carefully for you. The Patent Office is very, very unsympathetic to established companies with good administrative capabilities in other areas if you fail to pay renewal fees. They will look, you will need evidence, you will need argument, they will take direct evidence from the people involved in paying patent renewal fees, and if there's any hint that you haven't taken all due care, then you lose the patent forever, and of course the patent box benefit that goes with it. And we thought it would be useful just to put some real flesh on the bones of what we've just said. So we've got an example here, and it seems reasonable to use the HMRC's own example. We have a real patent drawing, which as you can see is fairly typically impenetrable as patents are, of an ink cartridge. And just the first few lines of the patent claim on the right-hand side there's a lot more to it, as you might imagine. But broadly speaking, this printer manufacturer has a patent for a liquid ejecting head, and then there's a plate and so on. And the rest of the claim talks about nozzles and ways of causing the ink to expand so it squirts out the nozzles. We have a printer manufacturer. It has, for the purposes of the case study, patents granted in the US, China, Japan and Europe. And we're going to look at this case study with dates of those patents in 2 places. So we'll look at those patents having filing dates before the 1st of July 2016, and we'll also look at an example where those patents have filing dates after the 30th of June 2016, so that they're under the new regime, and miraculously they've managed to get them granted in a very short space of time. So the European patent out of that list is going to be eligible for UK Patent Box. And as I mentioned before, a printer cartridge typically sold with a printer, definitely sold as spare parts afterwards, so it's likely to be allowed as an incorporated spare part of the whole printer. So the tax relief ought to be available for relevant profits for the whole of the printer.
The next slide shows how we have to look at the income and profits to calculate the patent box deduction. So first of all, we're going to be looking at the profits from the IP by working out the percentage of the qualifying IP income compared to the total income and applying that percentage to the taxable profits. The next point is to deduct a routine return. So the routine return is the profit a business might be expected to make if it did not have access to the IP. So it includes, for example, things like staff costs, the premises costs, plant and machinery costs, and miscellaneous costs. These costs are aggregated, multiplied by the ratio of the relevant IP income as a percentage of the total income, and then 10% of these are deducted from the patent box profits. The third step is then to remove the marketing asset return. Now, this marketing asset return is designed to exclude the element of profits generated from using marketing assets such as brands or other tangibles. So you can see from these boxes that you've eliminated your profit attributed to non-qualifying income, and that will be taxed at a corporation tax rate of currently 20%. You've removed your routine return, and you've removed the marketing asset return, and both of those amounts are taxed at the current rate of 20%. And what you're left with are the taxable profits, which relate to the patented items, and they are taxed at an effective 10% corporation tax rate. This slide actually puts some numbers to the patent box calculation. So first of all, we've got turnover line, where this is split between the non-patented income and patent income. So we've got here £800,000 of patent income. We then look at the percentage of the patent income to the total income, and here we have 80%. That 80% is then applied to the total profits of the company, which gives us the £240,000. As I mentioned earlier, we then deduct the routine return, which in this case we've got routine expenses of £500,000. We multiply those by the 80% percentage that we've calculated earlier, and then take 10% of that amount to eliminate the routine return, which is £40,000 in this example. This brings us down to a qualifying residual profit of £200,000. We then need to deduct the marketing asset return. In this case, it's been set at £50,000. In actual fact, in my experience, when you're dealing with small and medium-sized enterprises, the marketing asset return is often nil and can be argued to be nil. And actually, HMRC guidance states that the marketing asset return can be zero when the marketing activities only make a small contribution to the overall IP profit. Now, this is usually going to be the case where a company sells its goods or services to other companies who make their purchasing decisions on the basis of technical or regulatory requirements rather than based on it being a particular brand. So after we've deducted the marketing asset return, we end up with relevant IP profits, in this case of £150,000. And that's where you would stop under the old regime before calculating what would be your patent box deduction. However, under the new regime, we also need to look at this nexus fraction, so the R&D fraction that I talked about earlier. Now again, with a small medium enterprise, a single entity, small groups where the IP and the R&D is likely to be carried out in the same company or where it's subcontracted to a third party, the actual nexus fraction is going to be 1, so nothing will actually be deducted in this example. So that leaves you with relevant IP profits of 150,000. We then need to calculate the exempted profits. Now this looks at the difference between the current corporation tax rate, which is 20%, and the patent box rate, which is 10%. So in this scenario, you're then going to be reducing those profits by half. And that £75,000 is then what is called your patent box deduction. That amount is actually brought into your corporation tax computation and your adjustment of taxable profits, which gives you a tax saving at 20% of 15,000. So you can actually see it's a fairly complex calculation to come down to the tax saving, and it is definitely worth looking through this calculation before entering into the patent box regime to ensure that you are going to end up with profits from your patent box. Because as I mentioned earlier, if you end up with a loss in this situation, you can only use those patent box losses against future patent box profits, and therefore it's better to withhold electing into the regime until such time as you're making patent box profits.
Okay, one question that I've been asked, and probably worth mentioning at this point, is will forthcoming Brexit have any effect on this? And I think the question arises because the OECD changes were initiated by the UK and German finance ministers. It was clear the OECD was looking at this as a harmful tax practice potentially. And the UK and German finance ministers met, I think it was in 2015, at one of the G20 summits, and came up with the solution that the OECD has pretty much adopted. But just because that's how it came about, it's not an EU function, and indeed we don't in the UK have more scope to go back, for example, to the old regime once we leave the EU. Because actually the OECD would look quite poorly on that. So I don't think the Brexit question really affects this very much at all. Okay, thank you very much for joining us. I hope that's been useful. Of course, if you have any questions, do please ask any of the people on those slides there. And we'll be happy to help.
Thank you both for what was a tremendously engaging presentation. I'm sure lots of questions, which of course your contact details are available to answer them, I guess.